I spoke to the management of the company about what could potentially be in store for not just them, but also the sector. This is what they had to say. Listen in.
Well, I think one of the things that it's important to recognize is that whilst growth is tapering, there is still growth. Last year, there was some 14.5 million units sold worldwide. This year, we expect over 16 million EV units sold worldwide.
Right.
And so there still is growth. But there has been some concern, particularly with regard to the elections in Europe and in the US. And I think, fortunately, those things are behind us now.
Right.
There is some clarity in terms of policy direction. And we fully expect the decision-making now to align itself with the transition that's clearly going on in the industry in support of alternative propulsion systems and specifically plug-in hybrids and EVs.
Right. Well, and it's actually heartening to know that there is still growth, even though it's tapering. But, investors in general certainly want a better idea about what Trump 2.0 means for companies like yours. So I'm sure it's early days. He hasn't even taken office yet. But what could you possibly anticipate from this particular political regime?
Well, I think there's a couple of things that are clear. I think one of the policy positions that he's likely to advocate is the repatriation of manufacturing back to the US.
Right.
I think there's clearly going to be tariffs that are positioned with regard to the competition with different parts of the world. I think certainly in the short term that is likely to generate positivity in and around manufacturing in the United States. You know, what happens medium to long term remains to be seen, but we certainly expect over the next 12 to 18 months to have that positivity translate into investment and into decisions.
Right.
And we are certainly in the midst of a number of very encouraging discussions in and around those things.
Right. You know, Warren, to talk about Tata Technologies specifically, over the past 4 quarters, we haven't really seen any sequential growth. So it's been a challenging period for you all. Even as you see some of your large deals come towards the end of the cycle, where does the bulk of the growth come from now, here on?
Well, I think if you look at the aggregate position, one of the things that you have to do is really look at the business at VinFast and the business outside of VinFast. Yeah. You know, we've developed 2 electric vehicles for VinFast, VF6 and VF7. Those things are now those products are now being launched into different markets around the world. And as with all new energy vehicle companies, you know, they typically invest in new products, then they wait to see what the market reaction is before they further invest. And so we've seen a runoff of the business at VinFast. But one of the things that we're encouraged by is that we've been able to backfill that runoff with growth outside of that relationship. You know, if you look at last year, our non-VinFast revenues grew by 30% year on year. This year, our non-VinFast revenues will grow in excess of 15%. The base effect of VinFast, we're now through, and so that continued momentum within other accounts give us good confidence that the second half of this year will be better than the first half of this year. And that momentum we expect to fully take us into FY26.
Okay, fair enough. Also in FY24, you had about 60 clients who were in the bracket of $1 to $10 million. And you had about 3 clients who were in the bracket of over $50 million. Are the requirements of these clients different or considerably different? I'm sure there will be a lot of overlap. And do you expect to see a change in their requirements going forward?
Well, somewhat counterintuitively, one of the things that we are committed to strategically is reducing the number of customers that we work with. We want to focus upon top R&D spenders, and we want to focus upon those organizations that we can have very strategic and meaningful relationships with. And what that should afford us the opportunity to do is really intersect with the strategic imperatives of those customers, particularly as it aligns with new products and particularly as it aligns to the digitization of their enterprise.
Right.
And what we're seeing from the over $50 million a year customers all the way through to the $1 million a year customers is investments that they are making in us,
right,
in and around the portfolio of services that we represent. And again, that relates not just to new products, but also, again, to the digitization of the enterprise and investments in new technologies like AI.
Right. So actually, that was in fact my next question, because you do have, a tenured client relationship, and a lot of this is with very strong lineage. So my question then is, it's going to be more about focusing on the clients that you already have, not necessarily, look around and perhaps look to diversify at this point in time.
I think that's absolutely right. One of the things that characterizes the manufacturing industry is the importance of trust.
Right.
When you're given the responsibility to develop a next generation product, you're really being entrusted with the family jewels of that company.
Right.
And so commitment to that customer, particularly over the long term, informs trust and therefore provides the opportunity to really strategically contribute to the competitive position of that organization. And so that's one of the reasons, again, that we are looking to reduce the number of customers that we are focused upon,
right,
and invest in those relationships, not just in the short term, but in the medium and long term.
Sure, okay. So let's talk about the deal environment currently. The kind of conversations that you're having when it comes to the pipeline, what can you tell us about deal pricing? And I know we're coming out of some challenging times, but are you looking at an improvement in the pricing in which your deals are happening, and the consequence on operating margins then?
Well, if we look at deal pipeline, we did see somewhat of a slowdown, particularly in North America and Europe, in and around the election cycle. We've seen our customers look for clarity in terms of policy.
Right.
And fortunately, we're through that election cycle now, and we're starting to see clarity in terms of what's likely to happen in North America and what's likely to happen mainland Europe, the UK, and Scandinavia. And certainly over the last couple of months, we've seen improved confidence in terms of investment, and the types of conversations that we are having right now,
right,
certainly augur well, not just for Q4, but also for the next fiscal year. So we're very bullish in the context of the next 12 to 18 months.
Right.
And our order book and our pipeline are aligned in support of that.
Right. In your conference call, you also spoke about the reconsiderations your clients are making between EV and hybrid traction. Can you give us a little bit more of a picture there?
Well, I think as EV growth rates are tapering, I think most of our OEM customers are looking to balance their portfolio between legacy powertrains, plug-in hybrids, and EVs.
Right.
And we're seeing plug-in hybrids as very much as a bridging strategy in support of this transition that we are convinced will continue to build,
right,
from internal combustion engines to EVs. We are absolutely convinced that the pendulum has swung.
Right.
EVs will be the future,
right,
but in some countries and in some territories where infrastructure is a challenge, where policy is not necessarily aligned in support of EVs just yet,
right,
we're seeing some organizations look to hedge their bets through investments in plug-in hybrids.
Sure, point taken. Well, in that case, you've also spoken about smart manufacturing opportunities in AI, even, in fact, customer experience enhancement. Can you tell us more about that as well?
Sure. One of the things that I think the entire manufacturing value chain is focused upon is accelerating manufacturing throughput. And one of the things that organizations like ourselves are being asked to do is leverage technology, and specifically AI, ML, and generative AI,
right,
in support of smart manufacturing initiatives. And the sorts of things that we are doing is leveraging the contribution of sensors and data to make decisions in terms of improving scrap rates.
Right.
We're making helping our customers make decisions, again, in terms of optimizing and balancing their manufacturing assets.
Right.
And through that, either save money or accelerate the delivery of product to consumers. And we're seeing that across the board.
Well, there you have it. That's the management of Tata Technologies telling us about what's in store for the company. But with that, that's all that we have for this edition of KYC. But lots more lined up on the other side. Stay tuned to NDTV Profit.